So this is the big economic story. And if you're listening, well, I guess you have to be listening, so I don't need a conditional sentence on this. You, the listener, we're recording this a little bit early. Malcolm and I are going to be out. So we're covering some broader, big stories that will hopefully still be in effect, whether or not Iran attacks the United States, or if we get to artificial general intelligence, which then takes over our entire economy. So I think this story will stay relevant, which is that the debt to GDP ratio in the United States has surpassed 100%. So that means there is more debt than gross domestic product, all of the final finished goods made within the United States. And it is crept past 100%. After World War II, it was at 106%. And right now, sort of the payments as a percent of tax revenues, that's, down compared to the 90s. However, when you look at that graph, it's not misleading, but there are structural differences where interest rates were significantly higher in the 80s. And now it's a period of low interest rates. And this debt was built on top of, unlike World War II, not necessarily building up the economy. And so I look at this story, Malcolm, and I'm like, where the heck is all this money going? Is Elon Musk right? Does he need to get back in there with the chainsaw?
Is this all because buy now, pay later has made it easier to rack up more debt? Or does that not even factor into this because they don't actually report to the major credit bureaus the way that they...
Oh, dude, this is national debt. This is the amount of debt that the United States has taken out relative to...
I thought we were talking about our debt as consumers, not the debt of... Oh, okay. Well, that's always been the case, though, that the run it hot style economy, depending on who's in the White House and who happens to be the Fed chair and how much they want to allow it. Like, that's always been the case, that it just gushes money into the economy. And then when it starts to slow down, people borrow to cover it. And we keep on lowering taxes, which means the money's got to come from somewhere, which means we borrow some more. Yeah, that shell game, that's as American as a Jeep Wrangler or whatever the commercial is that is talking about dumping tea in the river.
Yeah, but this is the difference here is that it's gone past the 100% number. So is that an important metric that you now have more debt taken out than you do make stuff in a year? And the real thing that I'm looking at is interest payments is a percent of tax revenue, because that's like, where is all of this money going? And right now, I think it's at, I think it's like close to 20-ish%. Mm-hmm. So all of the tax revenues that are brought in, a fifth of that is going to debt. And to your point, yes, it has been a long running shell game, if you will. World War II, a bunch of money is taken out, but that's kind of gone back into the economy in terms of traditional manufacturing. Things go up and down a little bit based on whatever war you're in during the throughout the rest of the 20th century. And then Reagan comes in and he lowers taxes, and that causes a lot of debt to be taken out. And you also have interest rates spiking up. I think it would be like the late 1980s. And then that creates a huge level of just like, we're paying a ton of interest payments relative to taxes. Now it's creeping up because of sort of the same thing again, but also it's a little bit more systemic in terms of we're going to spend a bunch of money. The last stimulus that came out was from COVID, which I think you can easily argue that it didn't build the economy in the same way that World War II did, where, you're building up manufacturing. You have the GI Bill where people are buying houses after they come back from war. Now it's a little bit more handout-y with a little more fraud mixed in some cases. And so now it's, does anyone have the political willpower to take this under control? And I think that the answer to that is, this is a long-term issue. I don't think it means run for the hills, but it's something where I think if you're a younger investor, there are things you can structure with your own money that acknowledges this.
I don't know that that'll matter. I don't know that if and when it finally comes to a head, our borrowing binge as a government and as a society, I don't know that there's anything you're going to be able to do from an investment perspective that's going to save you from it. Because
really,
what that then means is you've got significant cracks in the credit quality of the U.S. Treasury, And if that breaks, then the entire financial system breaks. And so who the hell cares what the best performing stock in the S&P is at that point? It's going down too.
Think broader. So if there's a little bit of crack, what do they have to do in order to take this under control? And that would be raising taxes. And how many like common financial advisor pitches are, do you think taxes will be higher today or 20 years from now? And then the implicit answer to all of that is 20 years from now. And so one thing you can do, that's why I've saved in Roth accounts primarily, in part because I'm further away from retirement. You get more tax deferred growth, but I think that makes a Roth account where you pay the tax bill up front more appealing because of this. Okay. And then also the allocation to hard assets we've talked about in the past, because you're right, maybe having if cracks appear like that, a percent allocation to precious metals could make even more sense.
So this all was a ruse to get us back to why we should be buying gold.
You didn't even acknowledge the Roth part, though.
I followed you down the Roth rabbit trail, but it didn't occur to me. See, that's how good a magician you are. It didn't occur to me that the actual trick was turning this into a sales pitch for your beloved gold bullion. All right, so bringing this back to the point that we were supposed to be making in the first place, I do think that it's possible to offset that deficit that you're referring to, at least get it back down below the 100% mark. It's a very simple and obvious solution, which is just to restore manufacturing in the United States so that we eventually become a net exporter instead of importer. However, tariffing your neighbors and friends is not the thing that's going to get you back into that pole position.
We're done with tariffs.
Well, but I think to the point that you were making, the way that you incentivize the behavior that you want to see is through the tax code. It's as obvious as it can be. And so figuring out ways to incentivize companies to build and grow here in the United States so that we do actually export enough to offset that is the way to go. It just seems like, again, we as American citizens or as an American government have a problem actually solving the problem and seem to always want to just treat the symptoms. Yeah. And so it's going to be unlikely that we do actually pay that down or offset it, or even ever have, again, 1 year where we have a budget surplus at the end of the fiscal year. Like, God forbid. For that reason, but that is the very obvious solution that's staring us in the face.
Yeah, and we are podcasters right now, so we're not going to be rebuilding American manufacturing with our hands. I would say a few things to that as well. American manufacturing, yes, you need to build things within a country's borders. Right now, we're designing chips, which is working and may continue to work. I think there's the tax conversation, which those in the 1% say, hey, we pay, if not most of the taxes, it's above 40%. I think you need a simultaneous conversation of you may have to increase tax rates in some capacity. Good luck getting that through. But also on the other side, you have you need to be able to acknowledge the amount of fraud going on in the United States. And people need to see things getting built in a way that's better. That roads, hey, my taxes are up, but I'm seeing that the roads are getting better. Things are getting fixed quickly. I feel safe and secure. The city is clean. And it seems like one side has an interest in one of those things, and the other side has an interest of just kind of taxing their way out of it.
Well, also taxing the wrong people. Like, realistically, the enforcement arm that's being diluted or just chopped off completely at the IRS is not going after the people who uncovering their fraud would actually make a meaningful difference. Like, they're going after a dentist who makes $500,000 a year and is misappropriating $25,000 of expenses, instead of the person who's making $50 million a year and misappropriating $50 million of expenses. And one of them is going to have a much more meaningful impact on reducing the deficit and everything else. And the other is easier to get.
Well, who do you want to pick a fight with? Do you want to pick a fight with the 300-pound gorilla or the I guess a 50-pound monkey could still rip your
Well,
face
so that's
off.
the thing. Like, I hear that argument, but in reality, the U.S. government is almost undefeated when it comes to bringing cases against anybody. Like, when the DOJ decides to line up against you, they already know their case is so rock solid that your attorney is usually like, let's just find where the deal is here, because like nobody's getting out of this alive. So I hear you, but I think that's a weak argument from a bully who's saying, I could throw a punch, but I don't want to.
Yeah. And I mean, I think that makes 100% sense. My mind has changed, which my mind can do with new information. All right. So that's my thought on that. I think it's a huge economic story that will continue to be relevant. We'll continue to talk about it. The trouble from a news perspective is that this is so structural and so long running that you don't get like a lot of new grabby updates other than to say this is important and will continue to be important. And also there's a truth somewhere in the middle of everything's about to burn down, only buy gold. And also what I've heard from some bulls of this has been a story forever, therefore it doesn't matter.
Yeah, I feel that way more now than in I don't know how long, that everything feels as if everything's about to burn down tomorrow night. Like, and I try not to contribute to that overall feeling with my like what could go wrong here stance on a lot of the bullish appetite. But at the same time, like, there will be a time when a thing goes wrong, and you should at least be willing to acknowledge and consider that like nothing lasts forever.
Speaking of nothing lasting forever, this may be a quick story, we'll see, but I thought it was very interesting that MicroStrategy, the Bitcoin company, actually it's just Strategy now. The artist formerly known as MicroStrategy, now just Strategy, has changed its stance on whether or not it will sell Bitcoin. Because Michael Saylor, the CEO, if you were listening to him a few years ago, would say, I am holding Bitcoin forever. No, I will be a dragon keeping this hoard. He told Business Insider, we're not sellers. We're only acquiring and holding Bitcoin. Right? That's our strategy. Latest earnings call. President comes out. New CEO, Fong Li. He says, our ability to sell Bitcoin either to buy US dollars or sell Bitcoin to buy debt, if it's accretive to Bitcoin per share, is something that we would consider doing going forward, which is a little hand-washy. And to me, I think it is very interesting, as we've talked about on the show. Interest in crypto is waning. Mm-hmm. And we saw that in the, how much money does Robinhood make from crypto trading? It's down 47% year on year. And now even MicroStrategy, the biggest bull in Bitcoin, is saying maybe this relationship isn't forever. Malcolm, are you surprised to see a crypto bro being a little flaky?
Not really, because I think it's gotten to a place where he doesn't have a choice, or they as a company don't have a choice. I think they fought the good fight. They put up a brave face for as long as they could, while Bitcoin was going from 60 to 75 to 100 to 127 or so, where it maxed out. You needed to be that bull and keep on like championing it and getting it to go higher and higher. Now there's enough institutional ownership in the space that it is kind of obvious where the support level is, right? Somewhere around 60,000, we learned, is where support probably is for now in Bitcoin. And as far as I understand, within the MicroStrategy strategy, they actually need the price somewhere north of like 87,000, somewhere in that range.
Yeah, their average cost per coin is about 75. I'll say $76,000.
But then tack on the debt service related to it, right? Because remember, the MicroStrategy strategy is to load up on debt to buy more Bitcoin. And then once the price goes up some more, we load up on more debt at the new price and go buy more Bitcoin. And then the price goes up, and it's this shell game. And so I think they need somewhere in the mid to upper 80s as their price, just to have equilibrium and service the debt. And so for them, like, it's obvious when the price gets depressed for as long as it was below that point, that something's got to give. And either we're filing Chapter 11 now and having egg on our face, or we're coming out on a conference call and saying, well, nothing's forever. We got to change strategy. Stay tuned.
If you want to see how the economy has changed, Strategy was able to sell bonds, which is like we're backing with our stock, which is functionally Bitcoin, to go buy more Bitcoin. And it's a convertible note, so you get a little bit of a lower interest rate. 2.25% is hey, we need to take out a 2.25% loan in order to go buy a bunch of Bitcoin. And those bonds were oversubscribed. People were happy to give it to them because there was a narrative there, which is, yeah, but even if it goes down, I still get some money. So this is a safe bet because it's a bond. It's debt.
And those are the people who already own the equity.
Yeah.
And so it's I mean, imagine if Elon Musk was to issue 100-year bond on SpaceX or Tesla.
I think he could.
They would be oversubscribed in 8 minutes. And it would be the exact same people that are chomping at the bit to buy the SpaceX IPO and the people that have owned Tesla for 10 years.
Exactly. So anyway, I thought that was an interesting media note. And then this is something that I know you have a lot of opinions on, which is that AI can't trade stocks yet. There's a Bloomberg piece on this where they did a competition between all of the LLMs, a stock trading competition with 8 AI systems. It's the big dogs, ChatGPT, Grok, I think Anthropic got in the mix. But the big takeaway is that the portfolio as a whole lost about a third of its capital. Across 32 sets of results, a model finished in the profit only 6 times. Grok was the best at it. And that was because it placed a lower number of trades than Alibaba's did under the same prompt. So Grok trading about 160 times, the Alibaba bot trading over 1,400 times. So takeaways from this from you. Because I know you're about to cook here. I know you have a lot of thoughts on this.
So the most interesting or the most compelling thing to me about this was actually the most obvious, which was the reason that the bots underperform so severely was because they're prone to overtrading. And I thought that was a very interesting takeaway because that is also why human traders fail. It's because when things happen, they immediately believe that means they have to take action and they're prone to overtrading. And we could just stop there because that stuck out to me like a sore thumb. But separately from that, what I also took away was the fact that we're giving these LLMs way too much credit for how much they're going to displace what already exists based on some very tiny little nuanced show of development. So if you think about what is that? The Anthropic piece of code that they decided not to release because Mythos. So if you think about Mythos for a second and the fact that it was supposed...
Did you just call it a tiny piece of code?
Well, I mean, in comparison to what their broader suite of what Anthropic and Claude Code can do, it is one tiny piece of code.
They got the Federal Reserve chair and the Treasury Secretary in a room with a bunch of bank people saying this tiny piece of code is a huge problem.
Well, so that's actually where I was going. The fact that it initially rolls out, it's seen as a bad thing for cybersecurity stocks. Then we recognize, oh, wait, they pulled Palo Alto and CrowdStrike and Zscaler into the conversation. Maybe this is a good thing for stocks. Well, but then if they give up all their secrets, then they won't need them anymore. So there's a bad thing for their stocks. Instead of recognizing how limited Mythos, even as powerful, as supposedly it is, I haven't actually seen it run and wouldn't understand it if I saw the inside of it, honestly. But even as powerful as Thanos is supposed to be, it can only find the holes in the code. It can't actually patch them up. You still need human intervention to write the fix and to know what to do when the problem is uncovered. So yes, you found a great way to help the human cybersecurity engineers find problems, but you still need them to do the work. And all you've probably done is created a need for more cybersecurity engineers because we found more problems that are larger than human eyes would have been able to uncover on their own. So my point in all that is it's unrealistic to me that in a lot of these industries where we're presuming that because suddenly there is 1 or 2 models that can do 1 or 2 functions of what a person who does that job and has 15 or 25 years of experience in that field can do, it's overblown. And trading specifically, this thing's going to take over Wall Street, is another one of those widely held falsehoods that I think I'm glad to see that this is proving out in this way with people's actual money, because that's one thing that will help convince you that this is nonsense. If you're losing real money, you will very quickly say, this is stupid. I shouldn't be doing this.
In any relationship, it's healthy to keep score. So I would just like to say that since I inappropriately, you considered it was inappropriate, I brought a debt story back to gold. I had an AI stock trading story that you have brought back to your cybersecurity trading. So I think it best we're 1 for 1 right now.
I am just really great at drawing parallels. That's
Sure.
all there is to it.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
I was going to go in a different direction with this because tinfoil hat time, if you had an AI bot that was really good at trading stocks, I would not put them in this competition.
Yeah.
I would not want to know.
We wouldn't know about it.
If I were Renaissance Technologies and I'm really good at high frequency trading, then maybe I don't want to put my bot up against Grok when I have something specifically designed for this.
Especially considering Grok could scrape it and steal its secret sauce in 3 seconds.
You're not letting that thing out for anyone. And the other part of this story that I think is meaningful is the information that these bots were allowed to act on. So they didn't have access to the internet. They didn't have analyst reports. They weren't able to look at insider buys, that type of thing. And I wonder how this changes if they are able to scrape, a Bloomberg. What happens when you link it up with a Bloomberg terminal that it can scrape live? And I think that completely changes what's going on here, because then it's AI mixed with high frequency trading, mixed with sentiment shift algorithms that it's able to act on faster for stories that retail investors may want to react to as well. So to me, I think this is something where it looks like it's very easy to draw the conclusion that you drew, which I think is partially true, which is that these things are over trading and they're not great at it yet. But what happens when it is one part of a combined system?
Yeah, it's interesting too, because I've had clients even like with real money. We're not talking about people who stand to lose $10,000, $20,000 here. We're talking about millions of dollars at stake for some very smart people who will send me a link to like some trading bot that they've come across on the interweb somewhere and ask like, do you think this is a good idea? Do you think I should test this out in my Fidelity account or whatever? And immediately I'm like, what are you talking about? Of course not. Like, nobody wants to be the first one to test drive anything in this regard. But then also, I'm curious how long Fidelity and Schwab and Vanguard, I guess, allow things like this on their platforms. Like, how long can these things run undetected or kind of we don't care before they decide to intervene? Because like, we've got tools that are from much larger software providers that allow us third-party access to clients' accounts to be able to do stuff and manage stuff on their behalf. And Fidelity specifically has put their elbows out in the last 6 to 12 months in a very meaningful way. They've cut off like mint.com from accessing their account information. They've cut off all third-party, anybody who's trying to access accounts on behalf of somebody else. And so I have to wonder, like, if they're not wanting legitimate financial advisory firms to be able to access client info to help them, how much are they going to be willing to allow, your startup app that you vibe coded over the course of 2 weeks onto a platform like that?
You may have to go back to the Robinhood casino to do that. Which
I'm sure they'd be glad to let you experiment over there.
That's going to be a little bit friendlier. But to that point, that's interesting. I hadn't heard that because Mint.com, that's a budgeting app essentially. And then you have Monarch Money, which is also like, hey, you can see your net worth all in one place. And I could see a big brokerage firm like that being like, hey, why are we just giving you this information?
Because it's your information. As a U.S. citizen, I'm asking you for access to my own information so that I can make better financial decisions. Like that's an obvious 1 + 1 = 2. Yeah.
I think that's fair. Have you seen anyone actually make or lose meaningful money on this, or has it always been a hypothetical? Should I try this?
No one's admitted it to me yet.
Okay.
But I am sure that it exists.
Yeah.
It's usually one of those things that like we're not going to discuss it with our financial advisor unless it goes so well that we now need to keep score and throw it in his face that we heard him on that podcast saying it was stupid.
Okay.
Then I'll hear about it. But otherwise, I'll never know.
Our email is thistimepod@gmail.com if you want to throw anything in Malcolm's. I shouldn't say throw anything in Malcolm's face.
Please,
if you have something
because the interwebs are mean sometimes.
If you've made it 30 minutes into a financial podcast and you're that cruel, I would be surprised. All right, let's do this dividend piece. Speaking of Malcolm arguing into the void, he has a blog post out, Malcolm on Money. He has a newsletter that you should subscribe to. And the latest thing you have been arguing into the void about is trying to convince younger people to be interested in dividends. And my first question with that is that like, maybe this is just my circle of people. I think dividends make a ton of sense. And it would surprise me that a younger, sophisticated investor would say, this is something I'm totally writing off. I don't want any company that pays a dividend. And is that something you're seeing?
So not necessarily. I'm going to say it that way for a reason that'll be obvious in a second. But not necessarily, I don't want any company that pays a dividend. But more specifically, I'm not focused on the dividend and whether the company pays it. So I have heard, actually, folks that will say that like it's a signal that the company has given up on growth. And so if they pay any dividend whatsoever, then I know that that's a company I don't want to own because I only want growth in my portfolio. And these are people obviously in their like 30s, 40s that are very growth oriented. However, it's the other side of that I started with. The folks that are like, I don't really care if the company pays a dividend. That's not meaningful to me. That's more meaningful to like my grandparents who are retirees living on a pension that collect the dividend income with their muni bonds and are just kind of like chilling. They're living off the land now. They're not worried about growth like me. And I think that's a misnomer simply because, well, for two reasons. One, typically companies that have a history of growing their dividends over time tend to outperform companies that don't over like any rolling 10-year period. And more specifically and especially during down markets, they go down less and they recover faster. And the reason, the whole point of the article in the first place, is because those companies have a level of financial discipline that others don't. So even for like a Microsoft that I know you were going to give me as an example, or an NVIDIA that pays a very teeny tiny dividend in comparison to something like an energy company, a utility, a REIT, something like that. If you compare them against any other tech company, there are very few that pay even that little bit of a dividend. Like Apple's dividend is small in comparison to something in a different sector, but compared to anything else in tech, it's actually decent. So just the fact that they have the habit of being disciplined enough to make sure that they have free cash available to pay their dividend on time, and then also in their earnings announce a raise in the dividend every so often, that tells you a ton more about how disciplined that company is going to be with your money long term.
And I have also...
You think CoreWeave's got a dividend announcement coming at their next earnings?
Oh, wow. Congratulations. There's also an element too, which is that if you start a extraordinarily small dividend, you have a longer runway for being a dividend growth story. So it's actually something nice a leader can do, which is like whatever NVIDIA's dividend in, it's like teeny tiny. You're not buying it for the dividend. But Jensen Huang, thinking probably decades down the road, you're able to say, oh, we've grown our dividend, 3 to 5% per year over the past 20 years. And I think that's also a reason why you're seeing some of these long-term thinking CEOs do that.
He's playing 5D chess.
5D, is that even 5D chess, or is that just starting small and doing compound interest?
No. He is a visionary.
That is a calculator problem.
He's
not
doing 5D chess.
5D chess problem. But to your point, I think it is. This is the point is that if a company pays a dividend, you cannot invest in every growth opportunity you see. You have to return some amount of money to shareholders.
Except it feels like, to your point, NVIDIA is investing in every single growth opportunity that they see while also paying that minuscule dividend.
That's how much money's coming in. So that's the traditional way. That's the balance you're trying to find in a company with these stories, which is they're not able to go after everything. They can return some money to shareholders, but they're also not paying so much in a dividend that they are choking themselves alive.
Yeah.
And that's a concern I have had with Vail Mountain Resorts, which has been on my watch list for a little bit of time now, because I do think there is a compelling narrative where this company can turn around. Pays a 7.2% dividend, but the payout ratio, which is how much cash can we pay this dividend with, is 140%. So they're not making enough money to pay this dividend at its current rate. And then the problem with that is that once a company cuts its dividend, it traditionally doesn't bounce back. It's really difficult to come back from that, with rare exception where, companies cut their dividend in the middle of COVID because nothing's coming in. If it's more like, hey, we kind of lacked discipline here, then that's a real long-term problem and can often lead to a falling knife.
But that is very, very, very unlikely to happen. The dividend becomes sacrosanct once you announce that you're going to offer it. And so that also tells you a lot. If a company has gotten to a place where they can't figure any other way out of this mess other than to cut the dividend. So that's the reason why it's so hard to come back.
And except Intel.
Okay.
Intel suspended its dividend in the fourth quarter of 2024. And talk about a company that's come back off the mat. Granted, it wasn't with the same leadership team, though.
They also happen to be, I'm trying to figure out how to say this without hating on Intel.
Am I rage baiting?
They happen to be in the perfect right place at the perfect right time, with the perfect right investor appetite for anything microchips and AI. Like the fact that CPUs are now having a heyday in 2026 is amazing to me. One, it shows you just how important CPUs are to the data center build out in a way that, not enough people predicted. But it also really shows you just how much people are picking their stocks and trading momentum solely based on buzzwords, because there aren't very many people who are going to be able to explain to you the difference between a chip being built for a CPU versus a chip being built for a GPU versus a chip that's being built for inference versus a chip that's being built for training. Like, most people you talk to who are very pro Intel and have driven those shares up 200% in the last 3 months have no freaking idea why Intel is suddenly in vogue. They just see a chart that's going up and to the right, and they want to take that ride too.
I mean, that's a pretty easy one to understand, though. Their chips are good for inference, right? Prediction. So once you build your LLM on the expensive NVIDIA chips, you can move it over to the Intel chips, right?
How likely? That's like telling me that eventually, after I've been an iPhone user for 10 years, I'm going to jump ship and go to Samsung because their phone has way more AI embedded into it, and it can do a lot more than my iPhone can. Sure. Like technically I could, and maybe even I should. But what is the likelihood that I leave the Apple ecosystem to jump ship and go over to Android, get me a Samsung or a Galaxy Note or whatever? I can't even tell you what the phone models are that compete with the iPhone 17 because I'm not doing it. And that's kind of my point. Like, once you're in that NVIDIA ecosystem, you're not leaving for Intel.
Do you have any more hateful things you want to say about Intel before I get back to the dividend story? Because you said you didn't want to get fired up about it.
Yeah, now I'm regretting that you gave out the email address for people to send me commentary. But
I sense that. Well, maybe the argument back is that would be like saying the service to use Apple is for an iPhone user is $3,000 a year, but if they go over to Samsung and have to learn about a new phone, it can be $300 a year.
But that's my entire point. Do you care? Like, think about you're younger than I am, so this might be lost on you. But like, there's a saying from the 90s that nobody ever got fired for buying more IBM. Like, there was a time when IBM couldn't.
Yeah, I get that.
Like, they couldn't do any wrong in the server space. And so if you're a buyer on behalf of your company, you're going to go call your IBM rep and talk to them about outfitting your next location because nobody ever got fired for buying more IBM. Am I going to be the one to stick my neck out there to go check out what Intel's got going on when we already have a relationship with NVIDIA and we're getting shipped NVIDIA designed GPUs whenever they roll off the line? No.
It's I think if you want to update that one, it's no one's getting fired for being bullish on AI. I was fired because I was an AI bull. I believe in it. No? Okay. Anyway.
Wait a minute. That day is coming.
That day is coming.
Yes.
Okay.
If you got undisciplined to the point that you bet the farm on some facet of the AI build out that didn't come to fruition, you don't think that means the end?
I think it depends on, this is my cynical perspective, it depends on what level of the company you're at.
Right. So Larry Ellison is very fortunate that he can't be fired as the chairman of the board of the company he founded 50 years ago when he went all in on converting the company from being a legacy software provider to now building itself into being a leaser of GPUs to companies building in the AI space. Yeah. Like, that is the perfect example. He can't get fired. Mark Zuckerberg can't get fired. So these guys are fortunate, but there are several other people trying to emulate what they are currently doing that I guarantee you the moment that the appetite shifts or we have some breakthrough that means that we overbuilt, there will be several people who lose their job because they put their chips on the table in the wrong place.
Okay. As we start to wrap up this piece, is there any companies, I mean, Meta, Microsoft, NVIDIA, tech companies where you're like, I appreciate how this company pays a dividend that you talk to folks about?
You know what? One that is surprising whenever I bring them up to people is Iron Mountain. Folks that basically you see come into your office with the giant recycle bins, dump all the shred documents into it and then roll them back outside into a truck and roll off. But the reason I bring them up is because they are actually focused on income and growth simultaneously. So they pay a very healthy dividend. They're technically a REIT, but they're also working underneath the surface to digitize their filing system, their repository. They're working to make themselves a storage company, both in the cloud and also like physical record storage. And then they also sprinkle in AI every here and there in their earnings calls and sales documents. And so they're doing a lot of the right things, both to grow the dividend, but then also their share price has performed very well over the last year or so. And so I think that's an example of just looking at the performance or the payout of that dividend, their growth history of that dividend, and then extrapolating out whether the rest of what the company is proposing to do looks good to you.
So it's a 2.7% dividend, and then the price performance you're talking about is 52% year to date, 200% over the past 5 years. It is
a records management company, right?
And like, yeah. But as we're talking today, it's a volatile stock for a records management company, and it is at a close to an all-time high, if not at an all-time high. So something to keep in mind. But yeah, definitely one I'll pay more attention to. I know people who admire that company as well. Last story I want to talk about, which is this think piece in the New York Times. It is called "Meta is Dying. It's About Time," and it's from Julia Angwin. And I thought this was interesting because there are parts I agree with, there are parts that I disagree with, but clearly this is written by, it is sort of a case for the decline of Meta. And I think parts of it are true, but it is clearly written by someone who is rooting for the decline of Meta as well. So it becomes this sort of prosecutorial case against Meta, saying they have too much debt off the books, they're warping young children's minds, and look, in their latest quarter, they just saw monthly active users decline for the first time that this company has been public. And I agree with some of that, but also, they have, I think, over 3 billion monthly active users. So sometimes when you get half of the planet or close to the half of the planet on your drug, there are times where people lose access to internet, and there's some variability in that.
How much truth is there, though, to that 3 billion number? Like, how many of those users, quote unquote, have a pulse? How many of those users are between Facebook and Instagram and WhatsApp? Like, if I use all three platforms, am I 3 users or 1?
Or if I'm a bot.
Well, yeah.
If I'm a Russian bot posting religious memes on various political pages to try to stir up discontent within the country.
And the reason I'm so skeptical of it is because it just feels unlikely to me that you can go generate new users at this point at scale. Like, who doesn't know what Facebook is and does? Who doesn't know what Instagram is and does? Who doesn't know what WhatsApp is and does? So either your country just finally decided to lift the Iron Curtain and allow you guys to have access to it as a nation, which is very few and far in between at this point. Like, for the countries that have a hostile stance against Meta, they've already had it and will continue to have it forever and ever. So it's just odd to me that the monthly active users number continues to increase and the new users number continues to increase at a point when you have to have, almost absolute penetration at this point into the market.
Has an analyst ever asked them that?
I'm sure I can't be the first person to have that thought.
Yeah, I'm sure they've responded to this question. If they haven't, it's a great question. The part where I read this article and I'm wondering, what are you smoking, is this line, quote, TikTok traffics in more inspirational content. Prom videos are currently trending than in the divisive narratives that Facebook fostered, end quote. Have we reached at a point in a society where we are looking at TikTok and going, this is a much better alternative for time and attention than the feeds of Facebook and Instagram? It's like,
have you considered that it could have been written and distributed by a founder of TikTok?
That this piece?
Yeah. Like, who stands to benefit more from the demise of Facebook?
I researched the writer, and I don't think that I think she's a professor. I don't think she is a founder of TikTok. She's an investigative journalist and a entrepreneur. It does not say anything in here about being in TikTok, at least on her
parents
page.
Actually chat and GPT?
I don't know what her parents are doing. And
I feel like she could have been generated from some LLM that is posing at, like, I'm skeptical of anything that is anti-Facebook and pro TikTok.
That was the turd I was said. Yeah,
that immediately makes me think this person too is a bot.
There are things I read where it's one sentence where I go, I almost want to discredit everything else you say.
It's like a short seller report where at the very end they say, and by the way, we have a $75 million short position against this company, but don't worry about that.
Yeah. I mean, I guess my Onion feed, like my Onion headline on that is, I'm trying to think of 2 harmful drugs, but like, it's basically like saying drug dealer says that cocaine is safer than pick another harmful drug. Crack or whatever. Yeah, sure. So drug dealer says that cocaine is much healthier than crack. And that's kind of what I see. And it's like, there's a healthier alternative in TikTok.
Just like the Chick-fil-A cows wearing the eat more chicken signs.
Yeah, exactly. So the part that I do think is worth reflecting on, though, is the reminder that Meta has been using a lot of debt to fuel its spending. And a lot of that debt is off the books because they've put it in these what is it, different like business development organizations,
BDCs, yeah,
business development companies. So it doesn't count something like a $27 billion Louisiana data center. My wonder with that, in terms of keeping those companies off the books, does that ultimately hurt Meta if it fails? Or is it just like the private credit investors like Blue Owl Capital that get sunk on that type of thing?
It's even more so because Blue Owl can diversify their bets a lot better than I think maybe we're giving them credit for. It all would have to go to hell in a handbasket for Blue Owl to really like get destroyed, which, very possible. I'm not saying that that's not a legitimate concern, but who really stands to get screwed here is the developers. Yeah. Because they put a lot of capital on the line and front load a lot of the cost of building out these data centers, where the Metas of the world have very thin letters of intent that they're offering up to get people to put shovels in the dirt and start building. And they have a whole lot of options inside or clauses inside of these contracts that allow them to walk away before the whole thing is delivered, which then sends the developer or the backers of the project, the Blue Owls, scrambling to find someone else to come and take it behind them, which probably means, I don't know this for sure, but it probably means less favorable terms than what you initially ironed out with Meta. So maybe, where you were already relatively close to breaking even by the time it was all said and done, because the cost of everything required on the input side to build this thing has gone up over the 5 years you've been building it. Now suddenly you're having to sell it at a loss because Meta was allowed to walk away because they decided that, you know what, the technology we wanted to put into this thing 5 years ago when we struck this deal is no longer even in fashion. We need a different data center that can do something else. And so we're just going to walk away from this one. Thanks, but no thanks.
It was a letter of intent. We didn't give you any money.
And that's legitimately how this is, like, a lot of this is being built on spec.
So I think that's a fair point. And the question I had from this is who ultimately pays the price. And the reason I wanted to talk about this story too is because I think it's for anyone, any citizen that has an opinion on a thing, you need to engage with articles that directly contradict your beliefs on something. And reading this, my thought going into it is look at how much Meta can raise the prices on its ads, and advertisers are eating that. And I will give the author a piece of credit, which is saying that means they're not growing. That means they're juicing the price and seeing how far they can get away with it. And to bring it back to the Vail Mountain Resort story, that's the same thing that Vail did. Bringing up the prices of lodging and ski passes, and eventually people say, I want to take my ball somewhere else, or I'd rather travel to Japan or Europe to do a ski vacation than Colorado because it's cheaper. So I think that is a way it's caused me to reconsider my beliefs, think a little differently, even if there are parts of this article that I pretty solidly disagree with.
I will say though, I hope they're right. I hope that because it all hinges on Facebook, really. So maybe this is the slow unwinding of our addiction as a society to social media altogether. And I, as a person who is very anti-social media and has been for a while, would support that. I would welcome the demise of social media.
You can follow Malcolm at Malcolm on Money on Instagram. The other, and then last, before I really wrap up, the story I want to continue to watch is this lawsuit from book publishers to Meta, where they have claimed that Anthropic paid over $1 billion to settle, hey, we stole some information lawsuit, where book publishers basically said that Meta would go on copyrighted sites to suck up all the information from books to train its Llama AI model, and that they were doing that. They were doing that deliberately. It was not an accident. So the history of these big lawsuits against big tech companies is that they pay a fine and move on. Mm-hmm. But this is maybe the latest chapter on that. And the question is, will this time be different?
That's been since the beginning of time, though. Yeah. So this time will not be different. Like Kara Swisher wrote a book about Google back in like 2000 or 2002 or something. I can't remember. That was talking about her time on their campus, where basically they had cameras recording the news on like 20 different TVs all at one time so that they could ingest all of the news from around the world and have it be transcribed and available on Google. And she's like, what are you guys doing? Like this, this is clearly illegal. And they're like, oh, it'll be all right. Yeah. And like, that's 20 some odd years ago. And we're talking about all these different instances in between there where they've scraped the data one way or another. They've packaged it, sold it, made billions of dollars, and then the fine against them is $100 million. And they go, all right, glad that's over with. All
right. I'm at Rick Sislick. You can find me on Instagram and TikTok, which is the much healthier alternative to sucking in your social media slop.
The uncola.
And the thing Malcolm is at Malcolm on Money. The thing you can really do to help the show, share it with a friend, leave a comment or a rating wherever you listen. And thanks for listening. We'll see you next week.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.